Imagine that, in 2010, you decided to save $10,000 under your mattress, thinking it would be a safe way to save your money. You were calm, not worried about anything. But 14 years later, in 2024, you look at that same amount and realize that your purchasing power has drastically decreased. The money is still there, but you can only buy a fraction of what you could have purchased in 2010. Inflation is one of the biggest enemies of money that stays stagnant. The value of things increases over time. Every year, the money you saved loses purchasing power. Now, imagine that instead of keeping that money under the mattress, you had invested the $10,000 in stocks. In addition to investments being adjusted for inflation, you would have been receiving profits forever and even for your next generations. Many people think that investing in stocks is only for wealthy people. But if you think that way, you're wrong. You can start investing with just $10 in stocks of companies like Ford or Coca-Cola, for example. Of course, the larger the investment, the larger the returns. But if you don't have much, consider investing at least 10% of your income. Over time, you will see the snowball effect where your investments start to grow and generate more returns. The important thing is to start, even if it's with a small amount. Instead of letting your money sit and lose value, when you invest, your money starts working for you. Let's talk about it simply. When you buy stocks, you're buying a part of a company. If that company grows, the value of your stocks grows too. Plus, you can receive dividends, which are part of the company's profits, paid to shareholders. What are stocks and how do they work? As I mentioned before, stocks are small ownership parts of a company. When you buy stocks, you are essentially buying a part of that company. If the company performs well, the value of your stocks increases, and you make money. If the company does poorly, the price drops, and you may lose money. How do stock prices vary? It's quite simple. The price of stocks goes up when more people buy, usually because of good results or positive expectations. On the other hand, if more people sell, the price drops, usually because of financial problems or uncertainties. That's why it's crucial to keep an eye on company news, because they can make the stock price rise or fall quickly. What is inflation? Going back to inflation. Inflation is when the prices of things you buy, like food, gas, or rent, start going up, and your money becomes worth less. This means you can buy less with the same amount. This happens because there may be a lot of people buying and not enough to sell. Production costs rise, or the government prints too much money, causing it to lose value. A bit of inflation is normal and even good for the economy. But when it rises too much, everything becomes more expensive and harder to afford, especially for those with lower incomes. A simple example of inflation is the price of coffee. Let's say that last year, a cup of coffee cost $2. Today, the same cup costs $2.50. That's inflation. Prices rise, and the money you have in your pocket buys less than it did before. So, if you had $10 last year, you could buy 5 cups of coffee. Today, that same $10 only buys you 4 cups. Inflation affects everything, like food, gas, and rent, making life more expensive over time. Dividends. In addition to the increase in the price of your stocks, you can also earn dividends, which is a form of passive income. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble pay dividends regularly to their shareholders. For example, if you had 100 Coca-Cola shares, and they paid 50 cents per share, you would receive $50 every quarter, just for holding the stocks. Over time, if you reinvest those dividends, you can make your portfolio grow even more and create a passive income source. Diversification. A way to reduce risk is through diversification. When you invest in different companies, sectors, and even markets, you spread the risk. Meaning that if one stock or sector faces difficulties and loses, the other stocks in your portfolio may be performing well and balance out those losses. By diversifying, you increase the chances that part of your portfolio will continue to grow, even if another part suffers. Moreover, diversification can help protect your wealth during periods of high volatility, making your investments more stable. In the long run, a well-diversified portfolio tends to perform more balanced, taking advantage of growth opportunities in different sectors and companies, while minimizing the risks of significant losses. Therefore, diversifying doesn't mean just spreading your money around, but investing strategically to balance risk and maximize potential returns. Have financial planning. A solid financial plan is essential to reach your long-term goals. Before you start investing, it's important to define your financial goals like retirement, buying a house, or a trip, and understand how much you need to save and invest to achieve them. Assess your current financial situation, set a budget, create an emergency fund, and from there, start investing strategically. Planning also involves reviewing your investments periodically and adjusting your strategies as needed to ensure that you're on track to achieve your goals. Don't act on emotion. Investing based on emotions can be one of the biggest traps an investor can fall into. The financial market can be volatile, and impulsive reactions, like selling stocks during a dip or buying during times of euphoria, can harm your long-term performance. The secret to success in investing is patience and discipline. By sticking to your investment strategy and making decisions based on analysis and planning, you avoid emotional mistakes that can compromise your financial future. Remember, investments should be made calmly and with a long-term view.
Jingle bells, jingle all the way. Oh, what fun it is to ride in a one-horse open sleigh.
What song is this? Wrong answers only. Let's hit 100 subscribers before February. Guys, I'm counting on you. A hug from Quico.